podcast. Yeah, it's the Steve Gunner podcast. You're tuned in to the Steve Gunner podcast. Get up, it's the Steve Gunner podcast.
Welcome to another episode of the Steve Gunter podcast, where we discuss the steps, the strategies, and the mindset of real estate investing tailor-made for the pro athlete. I'm your host, Steve Gunter, and it's an honor and privilege to be with you today. Look, folks, today on the pod, we have Jason Kogok. He is the owner and founder of Investors Wealth Education, a training and consulting program for real estate investors. He is the author of Plug the Hole, Fill the Barrel, a beginner's guide to building wealth with real estate. He is also an investor and real estate broker with over 20 years of experience and a genuine person who I am glad to call friend. Jason, welcome to the podcast, my man. Jason, can you hear me okay?
I can, yeah. Just paused up for a second, but I can hear you.
Oh, okay. Welcome to the podcast, my man. How you doing?
I'm doing great. I appreciate it. I'm glad to be one of your esteemed guests.
Oh, man, you're too kind. You really are, man. You're too kind. Look, dude, I met you about 15 years ago.
Yeah.
When we were actually at a previous firm together. And one of the first things that I recognized about you, Jason, was that you had a love for Excel spreadsheets, dude. And I was like, what is going on? I thought we were selling real estate.
Yeah.
How did you become such a nerd? And I mean that, dude, in a very good way. It's a compliment.
Yeah. So, one of the things I kind of learned early on, especially when it comes to kind of like money and that type of stuff, is that if you learn how to use it as a tool and not necessarily as the end goal, that it changes your mindset and how you look at it, right? And so like, what's the most efficient way to use money? What's the most efficient way to invest in real estate or sell real estate or whatever? And so the only way you know that is if you're tracking it. And so what started kind of as a simple thing for me just to track personal finances and where I want to go and that type of stuff just kind of grew into now I got spreadsheets coming out that for all sorts of stuff. And so, yeah, that's kind of where it started. And so that's where I've ended up now, just kind of tracking all that stuff.
I love that, man. Basically always having something that you could visually see and say, I'm making progress or I'm not making progress.
Yeah. And then, how do you, not just like the progress, right? Like where I am, but it's always something that gives you the ability to tweak. Right. And so maybe I'm using one metric and I was looking at one thing and then inflation went through the roof. Right. And I'm like, oh man, I need to change this. Well, if you don't have that built in somewhere, you're kind of just guessing. Right. And like you said, I'm a nerd about this stuff. So I'd rather not guess. I'd rather know.
That is interesting that you say that, though, too, because those are the sorts of things that you don't think about. So I would imagine, I would say the beginner does not think about. But I would imagine that as you got started, you did not have as well thought out a plan or adjusting for all of these different things that could perhaps happen as you do today.
Yeah, for sure. I mean, when we first started, it's just, hey, how do I pay bills, put food on the table, keep a roof over your head? Like, what's that number?
Right.
But then as with anything, any field, as you get more experience, especially if it's something you like, you dive a little deeper and then you dive a little deeper. And then, you start to add some of those things in as you move through, like the cost of our childcare, didn't necessarily go up because of inflation, but our grocery bill did, right? And so how are you assigning some of those things as you plan ahead? And then what does it look like 10 years from now, 20 years from now, right? So those are all little metrics that I like to kind of pay attention to and tweak. And it's not perfect by any stretch, but that's the joy I get out of it.
Over the years, you've built a reputation, Jason, as a skilled investor. And as a result, a big part of your business has been advising investors. How much of that clientele has been customers that you've helped buy or sell a primary home? And how much has been just people that said, hey, I've heard about you.
Yeah.
I want to meet with you.
Yeah, luckily, I'd say in the last couple of years, I'm getting more of the "I've heard of you," right? That takes time. You have to prove that you can do something before the general public wants to use you. Up until then, a vast majority has been clients, sphere, database, friends, people like that have just witnessed kind of things that I've done, not heard me say it, but witnessed it. And so they're like, "Hey, can you help me? Can you help me?" And so that's been a big part of it. And I enjoy kind of giving back. One of the things that I think in our industry from an investment standpoint is a lot of people think, oh man, if I can't own 10 or 20 houses, or I can't go out and buy an apartment complex or a storage building or insert whatever, that, I can't be successful. And really what I'm reaching out to the average Joe per se, right? To say, hey, look, it's quality over quantity for most people, right? Most investors aren't going to own more than 5 houses, right? That's just the reality of it. And so I always reference it back and say, if you could only pick 5 stocks for your retirement account, would those 5 stocks each do something different? Like, wouldn't they be diversified? Wouldn't they have a different risk profile? Wouldn't one be cash flow and one be growth? And right. And everybody always says, of course, if I could only pick 5. And then I say, well, if you could only pick 5 houses to supplement that, why aren't you viewing it the same way? And I think a lot of people just go out and buy whatever, and that's fine. But I'd rather be strategic about it and say, hey, look, if I'm only going to buy 5, and the average person is, they all better do something unique to diversify and offset risk. And I think when you change your mindset and you view it through that portal, it's a little bit easier because now you're got some direction. You got some focus on what you're looking for.
Jason, that's so interesting that you say that, because generally when I'm speaking to especially the investor who's just getting started, one of the big points on their list is that, hey, I need to make X amount of money per month. And that X amount of money is generally like, okay, where are you going to find that at? I mean, it's just,
when you find it,
it's, yeah, it's interesting, but, and I get it because there are a lot of YouTube videos and just a lot of things, period, that people listen to that can lead them down the path of believing that there's only one way to this, and that is the way. When you talk about having a diverse portfolio, to me, that sounds like you have some that are perhaps really cash flowing for you at a great return. And then some of them just, it's more for appreciation.
Yeah. So that's a great point. First of all, everybody puts cash flow on a pedestal, and your cash flow will come. That's it. If you find a house right now where you're not putting down a tremendous down payment and if you pay cash, great, you'll have good cash flow, right? But that's not the average person. Yeah. So, the average person who's going out and putting 20 or 25% down on a rental property, if you're finding something that has amazing cash flow today, my guess is it might not be the best property, right? And so, yes, I chose cash flow. I chose that $400 a month, but I gave up maybe 1 to 2 to 3% a year of appreciation because I bought the wrong house in the wrong area. And so, yeah, great. I made, an extra $4,000 this year, and I gave up 15 grand in appreciation. And to me, I'm always that makes no damn sense. Because that $400 for most people they don't reinvest it anyway. It's gone.
Right.
Like when I talk to some investors, I'm like, okay, you have a couple of houses, you made $1,000 this past month in cash flow. Show me where that $1,000 is. Most people can't do it. And so it feels good to have it, but you're not using it. Like you're not reinvesting it. And so, you know, one of the ways I kind of try to mentor people is if you imagine a triangle, right? And, you know, you've got, let's say 5 lines horizontal in that triangle. You always want to invest on security, right? And so I kind of reference it and I say, hey, let's think about it as if you could only buy 5 stocks. Would the first stock you buy in your retirement account be Tesla or some pharmaceutical company? Or would it be Walmart, Coca-Cola, Procter & Gamble, Johnson & Johnson, right? Your 100-year companies that you say, hey, this is my first purchase. I want to buy safe, right? And so for me, I have an example. I say my Coca-Cola, my Walmart is a 3-bedroom, 2-bath ranch house I have out in Cary. And I know your podcast is national, but you know, Cary is a great place that I can rent all the time. Did I overpay for that property? Yes. Does it cash flow amazingly? No. But the point is now every decision I make after that is based on security. Then my next property is a little riskier, right? The last house we just bought was $425,000 for 700 square feet. Way riskier project, right? That's at the top of the triangle. It's the smallest portion, but it's the most risky. I can take that risk because I'm sitting on a base of security. Most people, for some reason, they turn that triangle upside down and they want to hit the home run first. And I'm like, you don't do that with any other aspect of your life. You don't do that with how you save money. You don't do that with how you invest in your 401k. You don't do that with whatever job you have. You're not quitting your job and going out and opening a business left, right. So no other aspect of your life do you do that. But because of YouTube videos and seminars and all this other stuff that's out there, you think that's how it's supposed to be done. And unfortunately, in our industry, we don't get to control the market, right? And so you build that triangle on the wrong end, some market conditions come your way, and you're done. And then you talk to all your friends about how terrible real estate investing was. No. Real estate investing is amazing. You just were a poor real estate investor. That wasn't the industry's fault. That was your fault. And so, yeah, I think building on a base of security, I always tell people when I work with them, especially from an investment standpoint, I am not a deal hunter. If you want a deal, I'm not your guy. First of all, if there's a deal, I'm taking it. Right. Very transparent. I'm very transparent with my people. If you're looking for a deal, I'm not your guy because I'm going to take the deal. I'm going to feed my kids before I feed yours. Maybe that sounds terrible, but that's the reality. However,
that's right.
If you want to build a portfolio, if you want to build wealth, and you've got a decade runway to do that, now we're talking. And that means that you're going to buy the first one where you're not going to brag to your friends about it. Right? I don't brag to my friends about my Cary house, my Johnson & Johnson. Nobody ever talks about their 401k and says, oh yeah, that Coca-Cola really knocked it out of the park. But
out of there.
Yeah, but if you look at your real estate, if you look at your 401k during a downtime, that's what saves your ass. Like that's what saves you. And so I think training people to change that mindset that the money comes later, just like it does in your 401k. That's the way to build wealth. And so, yeah, that's kind of the mindset I take on it.
That's good. I remember this some time ago. One of your first courses that I recall you offering was called Flip It. And I remember people being absolutely stoked about that course. And it was an amazing course, especially given the time period that we were in when you were hosting that course. Is flipping homes the best way to make money in real estate, Jason?
I think it depends on your goal. So the beautiful thing about the flipping the properties is that, hey, I got a short term here. I hopefully get paid a good check at the end. Now, granted, it's short term capital gains. So, you know, a lot of it goes to the IRS. And so if it makes you feel good to get that chunk of money, then flipping can be nice. Here's the problem with flipping in today's market. One is most investors that you see that are doing it have moved to the outskirts, the suburbs. They're flipping more blue collar price points simply because towards any city has gotten so expensive on the front end, right? The purchase, and it's gotten riskier on the back end. Like, what can I guarantee to get? That the margins, the spreads are for most properties super, super thin. Like, you're in the real estate market here in Raleigh. How often are you selling a property in Raleigh that somebody has flipped? It's gotten really, really slim. So you see a lot of people moving to the outskirts, and those margins are a little bit thinner, even though they may be a little bit easier. So I think it's a decent avenue to do. It's a highly competitive market. And I think too many people get into it that don't understand construction or houses. And so even if they have a fatter margin on a deal, a lot of them end up blowing it because they just don't understand construction or working with subs and that type of thing. If you don't need
so wait a minute, let me get this straight. Let me get this straight, Jason. So flipping homes, you're telling me it's based on market conditions and it's based on your knowledge about construction and handling that side of the business. Am I understanding that correctly?
Yeah, newsflash. Yeah. Exactly what you think it would entail
Right.
is exactly what it entails. And it's very capital intensive usually. And if you don't have the capital, you're usually borrowing private money, hard money. And the cost of that is very expensive. And so what we're seeing, the people that are flipping properties now that do really well are usually doing it in volume, right?
Right.
No one house is, every once in a while they get a home run. But truthfully, most of them are batting singles and doubles, and they're doing enough of them that they're making good income. And so that's where most people that do it consistently are doing it right now. One area that I've been trying to focus on lately is what is a value add strategy? What properties can I find that have an alternate use, even if that use is 5-10 years away? So, I mentioned that last property we bought. So, obviously what we paid and what we got, a lot of people kind of snubbed it and said, that's not great cash flowing. And so we turned it into a short-term rental. The cash flow improved somewhat. But the value play for us is to tear it down and build a duplex with an ADU in the back when construction and rates come down. So for right now, we're just buying our time. So was it a good investment as a single cash flow?
And an ADU is, to be clear, an ADU is an additional dwelling unit.
That's right. So our play the whole time was I overpaid for a single family rental. When we tear that down and build a duplex with a third rental in the back, everybody will be like, wow, that was really, that was a really smart, well, hopefully they say this. I mean, it makes me, but hey, that was a really smart thing to do. So what we're seeing now with prices being higher is don't stop investing. It's just make sure that you have an alternate plan B or something in the future that justifies what you pay today. Very similar with a stock, right? How many times are people buying stocks for forward earnings? I'm buying today's price for what that company is going to do in the future. And if I wait till they prove they can do it in the future, that price will be even higher. And a lot of people, I don't think, have that mindset to be patient, to wait for the market to come to them, if that makes sense. And in real estate investing in today's market, higher rates, higher prices, you either sit on the sidelines and wait for this unicorn, or you find what the future looks like or what you think it looks like, and then you identify properties that you can repurpose in the future to meet that need. And I think that's the current wave that most successful investors are operating in right now.
So the best investors, they have a long-term perspective, a long-term view of how their asset is going to perform versus a more short-term mindset and expecting, things to happen, is right away.
Yeah.
so to speak.
And I think if you look back in history and you think about all the people that we mutually know and individually know that have made money in real estate investing, there is a fraction of them that did it quickly. A fraction. Because they understand that while, yes, cash flow is nice, cash flow, until you own X number of properties or you own them long enough that your rents outpace your expenses, cash flow that makes a difference in your life is usually years down the road. I kind of give people the visual. It's I always tell people, look, real estate investing is like planting a tree in your front yard. And when you plant that tree, for the first few years, you water it, you fertilize it, you mulch it, you put stakes. Every time there's a big storm, you look out your window to think if that damn thing fell over and blah, blah, blah. And it's a pain in the ass. And you always say, why did I ever buy that tree in the front yard? And then you fast forward 10 years and you've got this beautiful tree in your front yard that you don't water anymore. You don't fertilize. It's got deep roots. And you're like, oh my gosh, that tree makes our entire yard now. But for those first couple years, you kind of questioned why you did it. And if you don't have that type of mindset, then maybe this part of real estate, maybe this part of investing isn't for you, because it's a heavy asset to carry and it's not liquid. And so if you're not prepared for the long haul, you might just want to look at a different asset class. It's not for everyone.
What made you decide to start a training program? Why not just, continue to offer your advice to, say, clients or friends and family who come to seek your advice?
Yeah, it's interesting. So as I think you did too, I got to go through that 2008 through 2011, 12 kind of downturn. And so as sales declined and that type of thing, I said, hey, good, there's an opportunity here to maybe teach people how to take advantage of the market and learn. And so I approached the local community college, Wake Tech, with an idea about doing a real estate course. And they said, look, first of all, you have no teaching experience. And second of all, believe it or not, Jason, real estate investing classes aren't doing great right now, right? The market was in the dumps. And I said, well, I'll make you a deal. I said, give me an opportunity. I'll teach for free. I'll teach for free. If you don't like it after a semester, you'll never hear from me again. And they said, well, we're a state school. We can't have you teach for free, but we can pay you the minimal, right? And I said, perfect. And so after about a year of trying to really they would call it annoying. I would call it persistence. They finally gave me an opportunity.
You sound like a salesman.
Yeah. You gotta know, right? I understand they perceived it differently than I thought I was giving to them. And after my first night of teaching there, it sparked something inside of me that I hadn't felt it in sales. I love closing a deal. I love negotiating, but there was something different there that I felt inside that I hadn't felt in other careers. And so right then I was like, I got to take this and just see where it takes me. And so that was 12 years ago. And here I sit today and it's slowly grown and I have big plans to hopefully grow it more. But again, one of the biggest things that I try to do is actually teach something that's valuable and not necessarily teach ideas that I can keep reselling to you for more income from it. And so I don't teach people how to own 100 homes or how to flip 50 in a year. I'm not your guy for that. There's plenty of gurus out there that you should follow. I know my lane. My lane is the mom and pop investor who is never going to own more than 10 homes, but is looking for a way to change their life. And it's not going to end up on a private jet flying to the Bahamas whenever they want. That's not my clientele, and I'm cool with that. And it's more rewarding for me to not have that clientele because the people that I help, I feel like it genuinely helps them, if that makes sense. Yeah. So
Absolutely.
That's how I ended up here.
Absolutely. I love that. I want to talk a little bit about your book. Plug the hole, fill the barrel. Plug the hose, fill the barrel. First of all, writing a book in of itself is a very heavy lift, and I commend you for that, Jason.
Thank you.
Especially, and I know you, and I know what type of business person you are. I know how busy you are with your business. You're also a family man,
Mm-hmm.
and you're busy with your family. So I know it's not to say that you just had no time on your hand other than
Yeah.
to do a book.
Yeah.
So I really commend you for that. But what I found to be so refreshing about the book, and you've already alluded to it, is how pragmatic you are in your content. It seems to me that it's a book that it's meant to guide anyone who wants to build a real estate empire, so to speak, and that's subjective depending on how they view that. But it's not like most real estate books out there that promise the reader to be like the next Sam Zell.
Right.
What led you down that path of simplicity and pragmatism as opposed to the grandiosity that, to be quite frank, it really does sell in the real estate
Yeah.
content business.
Yeah. For me, I just wanted something that was honest and that worked for me. Right. And so
Mm-hmm.
my path honestly has been relatively simple. It's put your head down, invest where you can, and let that tree grow as it comes. And so that's what led me to the way that I wrote the book. And I think one of the other things I really wanted to put in the book, and I think I did an okay job. I'm hopefully going to write another book in the next couple of years that will expand on this, but it's just adjusting your mindset on how we view money and how we view time. One of the things that I think is really kind of truthful in all this is, nobody wants a U-Haul following their hearse, which means that the reality is we view, I think a lot of times, our goal in life as these tangible or monetary things, right?
Mm-hmm.
When in reality, that's not the truth. Most of us just want to be able to own our time. That's it. Whatever we want to do with our time, I don't care what it is. If it's spending time with the kids and sitting in the backyard or drinking a beer on the beach or flying in a private jet to the Bahamas, whatever yours, at the end of the day, all you want is your time. And we have positioned ourselves, a lot of people, where we actually, instead of owning our time, we're selling our time in exchange for some sort of monetary kind of award, right? Our paycheck or whatever that is. And then we aren't treating that money as if it's a tool. And so what I tell people is, you need to focus on money as a tool, not as a goal. And how do I use that money in a way that I can actually start to own my time? Because that's what we truly want. And so, where do you invest your money, right? Here's a great example I use nowadays in my classes.
Yeah. Yeah.
If I sat $1 on your desk and $1 on my desk, those dollars start at the same place, right? But if you go and you take that dollar and you invest it into a bank account that gives you 5% interest right now, FDIC insured, and I keep my money at Wells Fargo, not knocking them, but Wells Fargo, and I'm getting 0.1%, right? At the end of the year, I've got $1 and a half a penny. You've got $1 and a nickel. We always blame the dollar. It's not the dollar's fault in that situation. That's Jason's fault. Jason used his dollar differently than Steve used his dollar. And the whole point of that is what ends up happening is Jason now has to go out and chase more dollars when Steve just said, I don't need to chase the dollar as much. I'm just going to use this dollar more efficiently. And in our world, every time we make more, we have a tendency to chase more. And so I tell people, hey, look, no, you just need to learn how to use the hammer better. Don't blame the hammer. And that goes so deep, right? Taxes. You and I briefly talked before we hopped on this about today, about taxes. People blame the IRS, they blame taxes. And I say, look, don't blame them. All right? Don't blame them. That's going to go nowhere. What you need to do is find out the rules and how to use those rules. And And when you start diving in, depreciation, recapture, short-term, long-term capital gains, like you can get a little bit of knowledge in all of these and save tens of thousands of dollars in your portfolio. And that means that's one less house I got to buy. That means that's one less 25% down payment I have to come up with. But instead of people doing the due diligence to learn something and to say, hey, how do I make that more efficient and effective? The easier answer for most people is, let me just go chase more of the tool I already don't know how to use.
Yeah.
And so part of, again, to kind of get back to the book, was not just real estate investing from a simplistic standpoint, but I really think people need to change their mindset about what they actually want in life. And it's not the dollar. The dollar is the tool so they can own their time. Their time is what they want. But again, we just turn around and sell it and sell it and sell it and sell our time left and right. And until you change your mindset on that, you're going to be just chasing your tail, I think.
You mentioned in your book that oftentimes, and I'm paraphrasing, but oftentimes novice investors think that they're just buying a house, but don't take into consideration what they actually own, such as the number of windows, the HVAC systems, et cetera. Would you mind expanding on that a little bit?
Yeah. I always say, like, if I own 5 houses, I don't own 5 houses. I own 5 roofs. I own 5 to 7 HVAC. I probably own 65 windows. And when you break it down, this goes back to my spreadsheets, right? When you break it down in its components, it allows you, I think, to be better prepared for the future. So how am I saving for those 5 roofs I'm going to have to replace, or those 65 windows or 7 HVACs, right? When you break it down in its most simplistic form and you save accordingly, you kind of you're never saving too much, but you're never kind of caught off guard. And so I think that's a really important way for people to view real estate as they get more real estate. Because a lot of times we catch ourselves bragging or boasting about, oh, I've got X amount of houses. And I always joke, I know people that own hundreds of houses. And in my mind, I'm thinking, oh my gosh, that sounds miserable. And it's not, they make great money and all of that. I mean, they work very hard to get to that point. But in my mind, I'm like, my analytical brain is like, holy shit, how many HVACs are you replacing this year, right? And how are you saving for that? And that's one of the interesting things, I think, when we talk about cash flow. I can make my numbers look however I want my numbers to look, to make me sound however I want to sound. But the reality is that there's all these other line items that maybe occur once every couple years that crush your cash flow. And so when you're chasing cash flow, it may feel good in April and it may bankrupt you in July if you're not prepared. And I think that's where you only hear one side of that story when you hear certain people talk. And I try to give you the whole picture because I think it's important.
To that point, if you're not saving because you believe that perhaps if you just have a home warranty on the property, that's all you need. What do you say about that?
Well, first of all, read the fine print in most home warranties. That's the first thing I tell you. Most of them have caps on how much they're going to pay for any sort of system. And so I think a lot of people get surprised on that. Most home warranty companies don't cover roofs. They don't cover foundations. They're not going to cover a window because it's old and you want a new one, right? So they have their place, but I think most people just put weight into that, and it doesn't really work. I always tell people you need to have what we call a CapEx schedule, and in essence, a CapEx schedule is all those big systems we just talked about, and how much is it going to cost to replace them. And approximately how long do I think I have left on said system in that particular house? And what most people realize, and it happens after they've kind of come to, is, gosh, I just bought a house with an 18-year-old roof on it. So if I'm going to replace that in 5 to 7 years, if I don't start with something already in that CapEx fund, I won't be able to save enough, even if I took all the cash flow for that.
Mm-hmm.
And so what I tell people is, hey, look, part of investing is to be prepared in advance. And so that means that if you buy a house and it's got that 18-year-old roof or 12-year-old HVAC, you better already have that CapEx fund started, or you're going to be behind the eight ball. And a lot of people, I know people that do this. They charge HVACs. And I'm like, you're charging an $8,000 HVAC at a 26% interest rate.
Yeah.
You should not own another property like that. That's dangerous to yourself. And I think just learning the basics would tell you that, right? And that's one of the big things that I think kind of people underestimate. And then they see that CapEx fund. This is another one. They see that CapEx fund build up, and they're like, "Oh man, I've got X amount of dollars in the bank. This is great. I should go out and do what they feel rich." If that makes sense.
Yep.
And I'm like, no, you better act like you don't have that money, because when you need it, again, I don't get to dictate when that HVAC blows. I don't get to dictate if it's during a month that I had good sales. I don't get to dictate if it's during a month that the house is vacant and I don't have a tenant in there. I don't get that luxury. And so I better be prepared for all different levels of and that's one.
My light's always going out, man.
Oh, I know.
It's just in my office. My lights like to go out. Thank you, sir.
You got that corner office with all that natural light I see behind you.
Oh, please. Don't start.
I love it.
You know, Jason, I mean, you're so right. And, you know, that idea of feeling rich really can go to someone's head really quick, especially when you see that pile of money in the bank and you're like, you know, oh, I'm getting ready to go do X, Y, Z, whatever that might be. Yeah. And it's just, it takes one time, one time. And then all of a sudden now it's like, oh, shoot. Now I actually do have to charge it to a car. You know, it's just it's crazy.
And I will say this, that happens less with people that view time as their goal versus money as their goal. So when I look at my bank account, now again, and I've been doing this 20 plus years, and I am blessed, and so I don't take what I have for granted, or I try not to. When I look at the bank accounts, I look at it as a tool. What am I doing with that tool? I don't look at it as, oh, I've made it, or I've almost done it, or any of that. I don't. Because until I can 100% own my time and do whatever I want, that is just a tool to help me get there. So a lot of that, when you're looking at your bank account and you feel that, you know, you got to change your mindset. It's the same thing when we see this in today's real estate market, where people will say, you know, the two things that I hear quite a bit in today's market is, oh, my house is worth X. And I, as somebody that went through 2008, I tell them as gently as I can, that means nothing. That is fake money. It is paper money. Unless you can go and take that money either from selling it or from leveraging it, it makes you feel good. Outside of that, it's damn useless. The flip side to that is the same if the market dips some, right? So if you have an investor who says, oh, I don't want to invest right now because we're at the top of the market. Well, first of all, you don't know the top or the bottom until you look backwards. So so calling a top or a bottom is useless until you look backwards and you know that that's where it was for that particular market. But it doesn't matter. Like if all of my real estate dips 10% tomorrow, I won't feel good, but I won't panic, because the day it only matters on the day I sell it. And so it's just a dip, just like your 401 dip. So I tell people, you know, hey, look, don't worry so much about the values there. It's kind of fake money. And the other thing that people talk about is, you know, is interest rates. You know, how many sellers do we have that say they're not selling because they have a 3% interest rate? And I say to them, it must feel terrible to be held hostage to an imaginary thing. There's so many people out there that are living in properties that aren't great for them because they are so effing afraid to tell their friends that they gave up a 3% interest rate to trade it for a 6.5%. And I'm like, first of all, I get it. Right? A 3% is better than a 6.5%. But I would much rather live the life I want to live in the home that is better for me from sun up to sundown than to worry about this imaginary thing that makes no point to me, if that makes sense, right? I mean, I get it. One's better than the other, but that's it. It's like taxes or anything else. It's a tool. And unless you're investing in interest rates and hedging markets and all, it's a tool. And you had a great run while you had it. Appreciate that you had it, but then move on with life. And God, there's just so many people out there that are held hostage to this thing. And I just don't get it. Now, great. Now, on the flip side of that, if you're in a house you love and you have a 3% interest rate, amazing. Stay put. Don't leave.
Right.
But there's a ton of people out there that are in this situation. They're like, oh, gosh, I can never give up that. I'm like, what a terrible way to live. What a terrible way to live that you're held hostage to this, interest rate. It just doesn't make sense to me.
Yeah. Keeping you there. You there. I want to switch gears really quick. You know, you're such a bright guy, man. And it seems to me that you spend a lot of time gathering information, consuming information, perhaps at times. What sources do you regularly go to in order to, consume information, read, or what are you?
There's a couple things that I do. Some of them are local. So I'm a huge fan of the Triangle Business Journal. Now, the Triangle Business Journal has multiple places. So that's, any sort of business journal for your city. I would rather pay $100 a year to somebody to do the research and give me the information than to save $100 and I got to go dig out where all this information hides. So business journal is really important for us here locally. I love the TAR report. There you go. So you got TBJ. So, that is great. The TAR report here locally is really, really good. That is another thing. So those are local. From a national level, I am a big fan. I watch CNBC all the time. And then I also anything that gives me, like Fannie Mae has a website where they kind of do mortgage updates and their forecast, things like that. On a national level, that's great. Now, I like macroeconomics, so I enjoy reading some of that, partly because sometimes you read some of those forecasts and you're like, gosh, I'm either totally wrong or that guy's totally wrong. Like we're looking at two different economies, right? And so it's good because sometimes you and I probably run into this. After doing something for so long, you naturally think you're right. Right. And unless you hear somebody else's perspective and actually give it cadence and actually give it weight, instead of just saying that person's wrong, but actually saying, wait a minute, maybe I am wrong. Let me evaluate that. If you don't take the time to learn those things and give weight to it, then you're doing yourself a disservice. And so I like some of that national stuff to see what people forecast and why they forecast it. Because again, when I went back to talking about, okay, where's the market going and how do I look for value add properties and alternative reuses to a particular house? If I don't know what the trends are, what the economy is doing, I can't really, I can't accurately estimate what that future looks like.
We're in a election year. Have you noticed any patterns, Jason, over the years in the credit and economic markets that cause you to behave differently as an investor?
The only thing this year that I think is going to be interesting. Well, there's two things. One, for the most part, I don't think anybody's super excited about anybody in our upcoming election, right? It's an interesting one where I think our upcoming election is more polarized about just people being angry at each other than it is about what can we actually get done. But one thing I do think in this year that's different, and I've kind of said this since the tail end of last year's, I don't think we're going to see as many rate cuts as people were thinking we're going to see.
Okay.
Yeah. So first of all, and you know this, and I won't go on too far of a tangent, but the Fed doesn't control mortgage rates. Okay. The Fed
Correct.
controls short-term rates. There's a trickle-down effect, but the news media doesn't understand how they operate either. They hear how they think they operate and they just regurgitate it. So then the general public thinks, oh, when the Fed, I'm waiting around because the Fed's going to drop rates at the end of the year and mortgage rates are going to go down. And I try to politely tell them that may happen, but there's an equal chance where mortgage rates don't, because mortgage rates are tied to the bonds and they're tied to mortgage-backed security. There's a whole nother world on how mortgage rates move. And I think a lot of people are confused about that. But beyond that kind of soapbox, I don't think we're going to see the rates, the short-term rates drop like they were predicting. And I've said that all along. I've said, first of all, the Fed is not going to do anything near an election. The Fed is not going to touch anything, I don't think, within 60 days of the election. So the election is beginning of November. So that puts us in September, right? We're in April right now. We have not had any cuts yet. The Fed, I think, meets, don't quote me, I think they meet 3 more times between now and September. No recent data report on inflation or anything like that has really given the Fed a change of tone, right? Where they're like, oh yeah, it's coming. Or we think they've kind of said, hey, right now we're staying the course. So I think maybe we get 1, possibly 2. Now, had there not been an election where the Fed within 60 days is probably like, look, any move we make is going to look political. So we're going to kind of just hang back. Had we not had the election, I think maybe we would have gotten 2, possibly 3. But I think come September, you can cash it in almost to the end of the year, that unless something dramatically happens where the Fed has to say, look, we have to do this, I think the Fed just sits on the sidelines because it's too hot to touch. And so, so in an election year, especially this year, I don't think the rates really change. I think, like I said, between now and September, we maybe get 1.
I see.
Yeah. So that's how I see it playing out. Which again, and while we're on the subject, if you don't mind, I will just mention this because I think also people want lower rates. I don't think people understand the consequence that comes along with that. And so what I mean by that is,
that was going to be my next question. Actually, I'm happy that you're pointing that out.
One of the things that I think, look, the Fed increases rates to make things more expensive, to slow down demand, to hopefully increase supply, and as a byproduct, hopefully bring prices down, right? That's how they want to combat inflation in very simplistic terms. So I flip it to people and say, well, why would the Fed lower rates? Well, they want to lower rates to spawn the economy, to stir it up, to get people out spending money, right? So that means that if they're going to lower rates, we're most likely in some sort of, whether you want to call it a recession or whatever you want to call it, we're in a slow period. Well, typically in a slow period where demand is down and they want to increase that, people aren't going out into businesses. They're not using disposable income. They're not going out to restaurants as much. All of these things happen. So what happens to the staff at restaurants? Well, I don't need 12 servers now. I can get away with 8. Not as many people are going to Home Depot. All right, well, I don't need a staff of 80 employees. I can get away with 65. And so what ends up happening is, and we've already seen it with large companies, unemployment will tick up. And so we've got all these people that are sitting on the sideline. They're waiting for these lower rates so they can act. And they're presuming that when that time comes, they will be in the same financial position they are right now when the economy's hot. And I'm like, look, I'd rather invest right now while the economy's good, even though I'll have a higher interest rate. Because once I get the property, they can't take it away from me, right? As long as I keep paying it, they can't. Or you got all these people that are waiting for these rates to magically drop and under the presumption that they will qualify the same way to go out and buy a property. And they're missing that, hey, when rates go down, it's probably because the economy is not doing so great. And there's a good chance that you fall into that category of I'm not doing so great. And so therefore, the idea of waiting until rates go down to act, to me, is like, you're just making this presumption that you're going to be in the same financial position. And a lot of us won't be. And so I'd rather strike while I can and pay a little bit more than roll the dice that I can't do anything, even though rates are lower. Like, rates being low, if you don't qualify, means shit. It means nothing.
Yeah. Yeah.
Nobody's going to give you the money.
Absolutely.
The rate is irrelevant.
Absolutely.
Yeah. Yeah.
Let me ask you this question. What are your thoughts on, being an investor who's doing it themselves and or perhaps joining a group of or forming a group of some kind to invest in real estate? What are your thoughts on that?
Yeah, so that is interesting. That has become a bigger kind of industry. So there's a couple ways that I've seen people do it. One is, you just open a pure money fund, pull in some investors, we all chip in, and obviously the person that has $100,000 can't buy as good as asset as the person that has $1 million, right? So you've got this leverage. The challenging part that I've seen some of those groups kind of bump into as of late is, what kind of return can you offer as it relates to what they can get somewhere else, right? So anytime we look at an investment, it's not what that investment can do for me. It's what that investment can do for me in comparison to where I would have put that money somewhere else. So for instance, if I can sit my money in the bank in an FDIC insured account right now and get 5%, at what level percent am I willing to risk that same money to where it makes it better? It's not 6%. It's not 7. Is it 8? Is it 9? Right? And so you may say, oh, wow, gosh, an 8% return is amazing. And I say, well, no, because that's only 3% more than I'm getting in the bank with zero risk. And so for me, I think some of these funds, they pitch good returns as it sounds, but people aren't viewing it as an opportunity cost that they're losing somewhere else, right? If I gave you $100,000 at 8%, but I had it at 5%, I didn't gain 8%. I gained 3%.
Right.
And what is my risk? And so I think where some of the funds have a tricky time right now is because returns in relatively safe asset classes have gotten higher. It's tough to find decent returns where somebody says, oh, I want to give Steve's fund X amount of dollars or whoever's fund X amount of dollars. So it can be great. I think it's, how do I offer a return that's really good? The other item that I think is that people that run those funds need to know is, what's the exit strategy for said investors? Like, how long do they have to have their money locked up? How ironclad is that agreement that I have with them, that it truly is locked up? And at what point is it worth it for me to let somebody out because I don't want to end up in a lawsuit and learn, right? So I might, let's say I gave you $100,000, I signed this agreement, and then my wife and I get divorced, and I'm like, hey, look, I need that 100,000, or I get a sick child, or I lose my job, or, not to sound grim, but look, life happens to all of us. And I say, hey, Steve, I want my money back. And you say, hey, man, you signed this 2-year agreement, you're not getting it back. And I say, look, I called my attorney and he says it's a mediocre agreement. And you're like, well, crap. I'm not going to spend $20,000 fighting you in court over $100,000. Now I have to find out, how am I going to buy you out? So I think those are the two things that are not thought about completely when people create the funds. But they can be great. They can be amazing. I just think you have to cross your T's and dot your I's in order to do that. And the last caveat to that I think is sometimes underutilized is, what's the wait period that somebody's willing to wait for their return? Like their internal rate of return, right? Their IRR. What is it? Is it, hey, I'm willing to, if you can give me a 10% return year over year, but I have to wait 5 years to get it because that investment really will mature in year 4 and 5. Like year 4 and 5, we'll be making a 25% return. But year 1, 2, and 3, we're making 6. So it may average out to be 10, right? But what is that length of time for that investment to mature that people really make their money? And I think sometimes that is tough to pitch that to investors. Like, hey, you're going to make 6% for year 1, 2, and 3. And somebody's like, I can do that in the bank. And you say, no. But year 4, 5, and 6, we're cashing it. And so you got to find that person that is liquid enough to say, I understand how money works and money grows. And so I'm fine to give you the seedling today because you're going to give me a tree in 5 years and I don't got to do any of the work. And so I think you got to find the right people to invest with that have that type of money. Because you start taking somebody's last 100K, they're going to be all over you. They're going to be all over you. Oh God, it's just not worth it. It's just not worth it.
Yep.
And that's why you see a lot of these, that is why you see a lot of these funds only work with accredited investors. Somebody who makes $250 a year has a lot amount of money because they understand that person understands that money matures over time and it doesn't necessarily mature equally each and every year. And those people that have a tendency to have more money have a tendency to understand that concept. And so they're not riding your ass all the time about those returns. They know it's long-term.
Last question for you, Jason. I am an investor just getting started. What are the steps that I need to begin taking today in order to get started in this new world that I'm embarking on?
So I always tell people to first know what your runway is, your time frame. So, the person that wants to cash out in 10 years is totally different property, totally different investor than the person that's going to invest and cash out in 25 years. So first start with your timeline. Your timeline is going to dictate your risk level, right? It's the same reason when people get to their last 10 years of retirement, they go into their 401k and they start making things more conservative, right? It's the same thing. Whereas somebody that's got 25 years, if I said, oh yeah, you should be investing in bonds, they're like, well, that's ridiculous, right? So first is understand your timeline because your timeline will dictate your risk threshold. Your risk threshold is going to lead you to what kind of properties you should be investing in. So if I've got that 10-year runway and my risk threshold is kind of low, I'm going to go out and I'm going to buy Walmarts and I'm going to buy Coca-Colas and I'm going to buy these properties that I'm going to feel like I'm overpaying. I'm not going to make a ton of cash flow on it. But in 10, 15, 20 years, when I'm in retirement, they're really easy to rent because they're always popular. They always have appreciation in any sort of market. And you won't brag to your friends about how smart of an investment that was for a decade or two. You just have to understand that when you tell your friend next year and they're like, well, that was a dumb decision, blah, blah, blah. You just have to tune that out. If you, though, are that person that's got 25 years or 20 years, but you're maybe not cash heavy, right? You don't have a lot of money to invest. I want to invest in this comes from John Kane, who's a big developer here in our area. He said something that really resonated. He said, get in the way. I said, what does that mean? Get in the way of growth. So if you have a timeline, he said, just get in the way. And what he meant is that you don't have to do all the research and be the genius and all that. Just get in the way. And if you get in the way, all of that commercial money, all of that development is just going to bring you with it because you're in the way. And so if I had 20 or 25 years, but I didn't have a lot of money to risk, I would try to identify where can I get in the way of big money growth over that time frame. So for us in our area, downtown South, right? In some of that industrial area, that downtown South, Sanford, Youngsville, some of those areas where, again, you buy your first rental house and your friends are going to be like, you bought a house in Sanford? And I said, yeah, I planted the seed. Call me in 25 years, right?
Yep.
But as somebody that has 10 years, you don't have that time frame to get there. So for me, anytime I advise a new investor, we always start with time. Because if I don't know your time, I don't know your risk. If I don't know your risk, I can't tell you what properties or what areas I would suggest. So I think that's the biggest tip I would give you.
That's good.
Yeah.
That's good.
Yeah.
Jason, man, what a wealth of information. How can people find you, man?
The easiest way is my website, investorswealtheducation.com. You can reach out to me. I do classes, I do consulting. We do renovation consulting and flip consulting. So if you're kind of new and you're like, hey, I want to do this project, but I don't know what I need to invest into it and all that, we do some short-term rental consulting. So, hey, look, what should I do for furniture? How should I position this? We do a lot of that stuff where novice investors maybe find a good opportunity, but they don't know how to squeeze the juice out of the berry. And so we do some of that consulting. So all of that, investorswealtheducation.com is the easiest place.
Awesome. And I also want to highly, highly recommend Jason's book.
Thank you.
Plug the Holes, Fill the Barrel, A Beginner's Guide to Building Wealth with Real Estate. And man, this is one day going to be a classic, man. People are going to see it as such. I promise you.
I hope so. And I hope the next one is as well. And I know we're wrapping up. Anytime I teach or do a podcast, I always try to kind of finish it with the same two things, if you don't mind giving me just a second. So
yes, please.
Again, time. You buy things with time, not money. It's not, I don't have a $3,000 mortgage payment. I got the number of hours it takes me to earn $3,000. So try to change your mindset to how you view money. Money is the tool. Time is the goal. So really, really, I think that would help a lot of people. And the second thing, and it's not real estate related, is I always kind of tell people, look, we live in a crazy world. Try to be a good human, right? And try to do the right thing and help people. We have a saying on our refrigerator, and it says appreciation before expectation. And it simply means, hey, take gratitude and try to do the right thing without any expectation back. And if you do that, you will be amazed what life brings you, because we all can make a shit ton of money and still be good people. And somewhere along the line, I feel like a lot of us have thought that they were different, and they're not. You can do amazing things with money for other people. And it doesn't have to be me. Giving back and helping other people, besides the feeling you get, I firmly believe it comes back to me. I know it comes back to you because we give without expecting it. And if it's just a little soapbox, but it's not real estate related. But I think if we spread that more often,
absolutely,
it just helps, if nothing else, in our own community. So
I love that.
Well, thank
you. I appreciate you as a friend. I appreciate you for coming on the podcast. And man, what can I say? You did it again, my friend.
Thank you so much. I'm always happy to help. You're doing great things. Your team is amazing. You're killing the Triangle and Charlotte and all of North Carolina. So don't discount. You're killing it, man. And I love your growth, and you always put your people first, and that's obvious. And that's sometimes hard to do. So kudos to you as well.
Thank you, my brother.
Yeah.
Well, Jason, appreciate your time, my brother.
Yeah, thank you. I'll see you later.
Yes, sir.
Can't stop, we can't lose. You can't win if you snooze. So do more and say less. So get up and let's work and be the best. Yeah, you're tuned in to the Steve Gunner Podcast. Yeah, the Steve Gunner Podcast. You're tuned in to the Steve Gunner Podcast. Get up, it's the Steve Gunner Podcast.